Namaskar, welcome to Kalam IAS. This is Vasudev Singh Bhati and Kalam IAS brings to you NewsKase. In NewsKase, we will do one important news every week. So this year's most important news in economy is that RBI has decided to keep the repo rate unchanged. So the headline in today's newspaper says that RBI keeps repo rate on hold as food prices remain high. So in this article, this talks about that the Monetary Policy Committee has decided to keep the policy repo rate unchanged as the food inflation is high and the current repo rate is 6.5%. The current repo rate is 6.5%. In the past 7 meetings that the Monetary Policy Committee meets in every 2 months, and so from the past 14 months, the policy rate has remained unchanged. It is 6.5%. So the reason behind is this, that the RBI is saying that though the disinflation is happening, that the rate of inflation has been reducing. It was above 7%, about one and a half years back, and from that time, the inflation has been reducing consistently, and currently it is around 5%. It is in the range of 5%. But despite that, the food prices are still very high, and the food inflation has kept the RBI said they will not reduce the interest rate currently because food inflation is still very high. Now, what do we mean by Monetary Policy Committee? So, what type of questions can be asked by UPSC on the Monetary Policy Committee in the prelims? So, in Monetary Policy Committee is basically framed under Section 45ZB of RBI Act 1934. So, the RBI Act 1934 was amended in 2016. In 2016, major changes happened in the monetary policy framework of India, and one of the biggest changes was Constitution of Monetary Policy Committee. So, the Monetary Policy Committee was constituted under Section 45ZB of RBI Amendment Act 1934. It was amended in 2016, in which the central government, the government of India, is empowered to constitute a 6-member monetary policy committee. So, the central government, first of all, under which act does it come? It comes under RBI Act. Second, who is empowered to constitute the monetary policy committee? It is the central government, that is Government of India. And how many members are there? There are 6 members in the monetary policy committee. In the same section, the purpose of establishing monetary policy committee is also written there, that the monetary policy committee shall determine the policy rate required to achieve the inflation target. The word used in the RBI Act is policy rate. What do they mean by policy rate here? Policy rate is basically repo rate only. So, policy rate, whenever you hear terms like benchmark rate, policy rate, repo rate, these are all one and the same things. So, Monetary Policy Committee shall determine the policy rate, the repo rate required to achieve the inflation target. Now, what is the inflation target for RBI, or what is the inflation target that the government India establishes? The inflation target currently is 4% plus minus 2%. The inflation target currently is 4% plus minus 2%, that the inflation should remain within the range of 2 to 6%. 4% minus 2% is 2%, 4% plus 2% is 6%. So, the inflation should remain within the range of 2 to 6%. Now, who has set this target? This target has been set by Government of India and Reserve Bank of India together. So, the Government of India and Reserve Bank of India together, they decided that the target of inflation for the next 5 years, in 2016, they decided the target is going to be 4% plus minus 2% for the next 5 years. And in 2021, again the RBI and Government of India held a meeting, and they again re-established the target for 4% plus minus 2% for the next 5 years. So, till 2026, the target still remains the same for the inflation. And in this agreement also, it is also decided, the agreement between Government of India and Reserve Bank of India, it is also decided whose responsibility is it to ensure that this target is met. This is the responsibility of Reserve Bank of India. So, the inflation targeting, that the inflation should be met, the target inflation should be met, is the responsibility of the Reserve Bank of India. Now, how many members or who are eligible to be members of the Monetary Policy Committee? The first person is chairperson. Chairperson is RBI Governor. RBI Governor is the chairperson of Monetary Policy Committee. Second is Next member is Deputy Governor in charge of the monetary policy. In the Reserve Bank of India, there is a governor. Under governor, there are several deputy governors. There is a governor. Then under governor, there are several deputy governors. So one of the deputy governors is in charge of the monetary policy. That deputy governor is going to be the member of the monetary policy committee. Then one officer of RBI, one of the employees of RBI will be nominated by central board. That is the board which governs the Reserve Bank of India. Central board is basically the board which governs the Reserve Bank of India. So Reserve Bank of India is headed by the governor of the RBI, and it is it is regulated, it is maintained by the central board. Central board is the highest decision making body and under which the governor works, and under governor there are several deputy governors. So the governor is part of the monetary policy committee, the deputy governor in charge of monetary policy is part of the monetary policy committee, and one more employee or officer of the Reserve Bank of India who will be nominated by the board itself. So the board will nominate one officer of the RBI. So these are the three members who are all employees of or officers of the Reserve Bank of India. Then there are three persons who are appointed by Government of India. So there are 6 members, 3 from RBI and 3 appointed by the Government of India. And whenever the decisions are made in the Monetary Policy Committee, decisions are made by majority. That you have to have at least 4 votes. So in a 6-member body, to make a decision you have to have 4 votes. But in case there is a tie of votes, there are 3 votes to favor the decision and 3 votes against the decision, then RBI governor, the chairperson, RBI governor can make a casting vote. The RBI governor can make a casting vote, and his decision will be final, and he will have one extra vote. After that, that decision will be made. So this is about Monetary Policy Committee. About Monetary Policy Committee, UPSC has asked questions in the previous year also. In 2017, there was a question upon Monetary Policy Committee that which of the following statement is or are correct with reference to the Monetary Policy Committee. Now, the first statement is, it decides RBI's benchmark interest rates. Now, as I have said it earlier, the policy rate, the benchmark rate or the repo rate, all these things are one and the same thing, that is repo rate. So, it decides the RBI's benchmark interest rate. This is true. In 2016, Monetary Policy Committee was established. In 2017, this question was asked. So, it decides the RBI's benchmark interest rate. Second question is, it is a 12-member body. So, it is not a 12-member body, it is a 6-member body. So, second statement is not a correct statement. Third statement is, it functions under the chairmanship of Finance Minister, Union Finance Minister. Now, we know that Monetary Policy Committee is headed by the Governor of RBI and it is a 6-member body. So, second and third statement are wrong statements here. So, the answer are here, 1 only, 1 and 2, 3, 2 and 3. Answer here is 1 only, because second and third statement are wrong, only first statement is correct here. So, answer here is A. Now, if you think that UPSC is going to ask very difficult questions in prelims, that is not the case. Although the questions in 2016-17 were relatively easy compared to the questions of 22-23, but still there are a lot of easy questions in 22-23 also. For example, Monetary Policy Committee in 2016, it came into existence, and in 2017, such simple question was asked by UPSC in prelims. So, economic questions are relatively simple if you ask me, especially in prelims. Now, next is tools of monetary policy. Now, the Monetary Policy Committee decides the repo rate. What is a repo rate? Repo rate is basically rate at which RBI lends money to the banks. Repo rate is the rate at which RBI lends money to the banks. So, it is also known as policy rate. So, what is the process? Process is that RBI will give money to the banks. If banks need some money which they cannot find anywhere else, and also they need that money on a low interest rate, so they will go to the Reserve Bank of India and ask Reserve Bank of India to give them money. Reserve Bank of India in return would ask certain collateral. Now, what is that collateral? That collateral is government securities. So, the banks will give government securities to the Reserve Bank of India, and Reserve Bank of India will give certain money for a specific period. For example, 91 days or 182 days. So, these repos are conducted most of the time. Repos are conducted less than 1 year. These are conducted for less than 1 year, and the full form of repo is repurchase obligation. The full form of repo is repurchase obligation. So what actually happens is, Reserve Bank of India, for example, on 1st of January, Reserve Bank of India will say, okay, I will give you the money, you keep your government securities with me and I will charge 6.5% interest rate upon it, and the money is given for 3 months. Now after 3 months, the bank has to repay money with interest, that is 6.5% interest, that is per annum. So according to which they will calculate interest for 3 months, and the banks will return that money to the Reserve Bank of India, and RBI will return these government securities to the banks. So this is how this agreement is done, because on the day when the RBI gives money to the banks, there is also an obligation that the banks will repurchase these documents from the RBI. Today RBI is purchasing these documents from bank, that RBI is giving money and taking this these government securities. They are also engaging in an agreement that after 3 months, on this particular day, at this particular price, you will pay me this much amount of money and I will again give you your securities back. So that is why I say that this is a repurchase obligation. Banks have an obligation to repurchase these securities from the Reserve Bank of India. Now after this reverse repo rate, the repo rate is the rate at which banks can borrow money from Reserve Bank of India for short term, but there is a limit to it. There is a limit which is set by Reserve Bank of India only, depending upon the size of the assets of that particular bank. And once the bank exceeds that limit, for example, this bank is HDFC Bank and it has a limit of 100 crore rupees that you can purchase, you can take loan from Reserve Bank of India of 100 crore under the repo rate. But HDFC Bank has already taken 100 crore loan from RBI under the repo rate, and HDFC banks need more 20 crore rupees. So RBI will give that money. That is not an issue for short term only, but the rate of interest will be higher, and that rate is called marginal standing facility rate. That rate is called, earlier it was called bank rate. Today it is called marginal standing facility rate. So marginal standing facility is the rate at which RBI lends money to the banks for a short term period, that is similar to repo rate, but only after the banks have wants that money above the limits that are set by repo rate. So banks have exhausted the limit that are available under repo rate. So this is repo rate. Next tool by Reserve Bank of India is reverse repo rate. So what is reverse repo rate? Reverse repo rate is exactly the name suggests. This is the rate at which RBI borrows money from the bank. Earlier, the banks were borrowing money from the RBI. Now, the RBI is borrowing money from the banks. RBI actually does not borrow money from the banks. It is the banks who need to park their money with the RBI. Sometimes whenever there is less demand of cash in the economy, then the banks will put their money in the RBI so they can earn certain interest. So in repo rate, the transaction is reverse repo rate, the transaction is reversed, that now the banks are giving money to the RBI and RBI is keeping certain government securities with the banks. Next is RBI step in high inflation. So we have seen in today's news that the Reserve Bank of India or the Monetary Policy Committee has kept the repo rate unchanged because of high food prices. Now, what are the steps that the Monetary Policy Committee or Reserve Bank of India takes in case the inflation is high, as is the case in today's newspaper? So inflation, how does inflation is affected by money supply? Now what does the RBI do is, RBI controls the money supply in India. How do they do that? They do this by changing the interest rate. If they keep the repo rate high, the SLR liquidity, the statutory liquidity rate, CRR rate high, then what will happen is that the liquidity in the market will reduce and the amount of supply in the supply of money in the market will reduce. If the supply of money in the market reduces, then that also results into increase in value of money or reduction in inflation. In other terms, inflation and money supply have direct correlation. You understand in this way that if you have more money in your pocket, then you will be willing to spend more money. The person who has more money in their pocket is willing to spend more money, and if you are willing to spend more money, then that will result into increase in demands of goods and services. And we know from basic economic concepts that whenever the demands of goods and services increases, the prices of goods and services also increase. For example, today nobody is willing to buy this remote, then the price of this remote will not rise, but suddenly the demand for this remote has increased. And if the demand increases more than the supply, then the price of this remote will also increase, because supplier wants to make maximum profit, and he knows there are a lot of buyers who are ready to buy this remote. So whenever the demand increases, the price also increases. So money supply increases. Because of money supply, people's spending will increase and the demands of goods and services will increase. And if the demands of goods and services will increases, then the inflation also increases. So this is the basic correlation between inflation and money supply. So increase in money supply, increase in demand, increase in inflation. So what is the solution to this problem? So whenever we hear that the inflation is very high, just a few days after that, we will also hear news regarding, the steps taken by Reserve Bank of India to control the inflation, because we know that inflation target is given to the RBI by agreement between the Government of India and Reserve Bank of India. So the solution is contractionary monetary policy. What is contractionary policy? Contractionary policy basically tries to reduce money supply in the economy, because if the money supply is high, then the prices of goods and services will also increase, and there is an inflationary pressure on prices of goods and services. So, the RBI will engage into open market operations. OMO is open market operations. So, open market operations, they will sell the securities. When they sell the securities, they get money from the economy. Similarly, as we saw in repo rate, that reverse repo rate, that they give securities to the banks and take money from them. Similarly, RBI conducts open market operations where they sell securities which are available with the RBI, the government securities. They will sell those securities in the market to the people and take money from those people. Similarly, increase in repo rate, any rate for that matter, be it repo rate, marginal standing facility rate, cash reserve ratio, statutory liquidity reserve ratio, reverse repo rate, any rate which is determined by Reserve Bank of India or the Monetary Policy Committee. In the contractionary monetary policy, the RBI or the Monetary Policy Committee will increase those interest rate. So increase in repo rate, bank rate, marginal standing facility rate, all these steps are taken in contractionary policy. So what do we mean by contractionary policy? The liquidity in the market is reduced. Increase in CRR, SLR, that is also part of contractionary monetary policy. Now, as we have talked about contractionary monetary policy, we will also talk about the types of monetary policy that are available. First is expansionary policy, next is contractionary policy. Now, in expansionary policy, the money supply is increased. What they do in money heist? That they print their money. They print their money. Similarly, in expansionary policy, RBI will print money. Reserve Bank of India will start printing money whenever they have to engage in the expansionary policy. And what are the other steps that can be taken by Reserve Bank of India to increase money supply in the economy? Exactly opposite of what was done in the contractionary monetary policy. In contractionary monetary policy, which is also called tight money, because the money supply in economy is reduced by the Reserve Bank of India, they increase repo rate, they increase bank rate, marginal standing facility rate, cash reserve ratio, statutory liquidity reserve ratio. The opposite of that is done in the expansionary policy, which is also called easy money. Easy money is, the money is easily available in the economy because money supply is high in the economy. First is of course printing money. Apart from that, reduction in repo rate, reduction in bank rate, reduction in marginal standing facility rate, reverse repo rate, any rate for that matter, reduction in cash reserve ratio and reduction in statutory liquidity ratio. So all these steps are taken in the expansionary monetary policy, and we have already talked about contractionary monetary policy. Which of these policies adopted by RBI whenever the inflation is high? Whenever the inflation is high, that is because the money supply is very high. RBI would not like to increase more money supply and add fuel to the inflation. RBI would like to reduce the money supply. So RBI engages in the contractionary monetary policy, as we have seen in today's newspaper that RBI has kept the repo rate unchanged, has kept it high so that money supply in the economy could be controlled. Now on the expansionary monetary policy also, there have been questions in the 2020 prelims. So in the 2020 prelims, the question was asked, if the RBI decides to adopt an expansionist monetary policy, which of the following would it not do? Would it not do? So which of them is part of expansionist monetary policy? First is cut and optimize the statutory liquidity ratio. We have already talked about it that whenever RBI wants to engage in expansionary policy, RBI will reduce the interest rate, whatever the interest rate that is. And whenever RBI wants to implement the contractionary policy, RBI will increase the interest rate. So here the question is about expansionist monetary policy. So for expansionary monetary policy, the RBI could cut the statutory liquidity ratio. So RBI can do this. So this is not the answer for this question. Second is increase the marginal standing facility rate. Now increase happens in the contractionary monetary policy. So this is something that RBI would not do while adopting an expansionist monetary policy, that because that would happen in the contractionary monetary policy. So second statement is the correct. Second statement is correct as per this question. Third is cut the bank rate and repo rate. Again, cutting of the bank rate and repo rate is part of the expansionary monetary policy. So this is something that RBI would do. The question is about which of the following would it not do? Would it not do? Only two. Only two is the answer here. So we will see the options. That is 1 and 2 only, 2 only, 1 and 3 only, 1, 2 and 3 only. 1 and 3 RBI can do in the expansionist monetary policy, but 2 is something that the RBI would never do in an expansionist monetary policy. So the answer to this question is 2 only, that is option B. So this is it from my side today in this week's news case. We will meet you in the next week's next topic. Thank you very much.